The S&P 500 fell for a fifth straight day, is now down 100 points from this most recent high it has. Is a 62% Fibonacci retracement enough to say things are really bearish now? So we're going to check that out and examine that from a technical perspective. Also, have we seen this before? Have we seen a pattern like this before? And when? When was it? I'm going to show you that. Also, we're going to talk about how volatility moderates, what kind of stages it moderates in. We're going to break all that down today, and today's trade idea looks in an area that has held up really well during this 5-day decline, and with the expectations that it can continue to do well going forward. So let's go ahead and get started. Today is Wednesday, November the 14th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's get right to it then. Take a look at the S&P 500 with the market forecast indicator. You can see we got that bearish posture, renewed bearish posture against the intermediate line down, and the oversold short-term sentiment that's bounced a little bit today, but still obviously oversold. And again, I've talked about before that if the near-term line gets in that reversal zone, that we would trade in this area here. There's a strong low point at that low. That's a strong support. It's a long lower shadow on the weekly chart, so keep that in mind. But you also notice we came down and hit that 62% Fibonacci retracement of the rally and hit it on an intraday basis today before bouncing up at the end. And so another bearish day we've had. We're down 28.15 down to 27.01, so about 115 points. After rising 215 or 200 plus points previously, so a little bit more than 50%. And again, if we're going to quantify how big of a drop that is, we also have to realize how big of a gain it was beforehand. Similar here, that rally right there after the drop, the rally was still just a Fibonacci bounce up. Didn't go up as much, but still was just a Fibonacci bounce before another move down. So we'll see. If it ends up being holding support in this Fibonacci zone that we still had, we ended up still in the 4-week range, around the middle of the 4-week range on SPY. You'll see here in just a minute. Intermediate line market sentiment falling, bearishness again, dark pink shading on the chart, similar to what we see right here, over here back in April when we had, you can see over here we had a retracement off of that long lower shadow that was on a weekly chart. Because see, this was a Monday right there. So we opened up in this area. We came all the way down and then rallied up to, it would be right here. No, right here. We ended up rallying up to that point, closing lower. So that opened down to that close. And there's your lower shadow all the way down to there from that close. So a long lower shadow at that point that we closed above the next week. So very similar pattern here that we got, you notice, down to the 62% Fibonacci retracement of that line. Held that for support. Busted down a little eventually here on an intraday basis before closing up in that Fibonacci retracement zone. And then we busted up to the upside. So again, what we're seeing here, we've seen before. We've seen it right over here. After a brief, a bearish posture for a while, bringing the market sentiment line below 50, getting a brief intermediate posture, dark green, that lasted a few days. So now, again, the question is, do we break through the new lows, and this is just the beginning of that, or do we bounce off of it like we did here and get right back to a new intermediate posture that will last longer? So, again, seasonality and all the other factors I've talked about ad nauseum before would suggest that we should expect this kind of a move like we've seen before, rather than expect the move that we had at the end of 2015, which you'll see here on a weekly chart, the end of 2015 where we broke down here and formed the death cross on the S&P 500. So I'll show you the difference here when we get to the weekly chart. Let's look at the other indexes really quick on the market forecast. You can see again, still in the Fibonacci retracement zone on the Dow. 25,000 is an important number. Not only is it a big round number, but it's also the 62% Fibonacci retracement level. The NASDAQ went through it a little bit because a lot of this weakness here during this week is really tech oriented. And then finally you can see the Russell 2000 also a little bit below it too. But remember, they never did get above 50 on their intermediate lines, like the S&P and the Dow did, and oversold sentiment there. Okay, before we look at some other charts, just a reminder to subscribe to our YouTube channel. Click that or mouse over the Market Scholars logo right here in the bottom right corner of your video. Click the red subscribe button that pops out. Also, click the thumbs up icon down below the video. That tells us you want us to do the video again tomorrow. Really quick way to give us feedback there. Comment down below on anything that stood out to you from tonight's video. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click that link to subscribe. Follow me on Twitter for more content like this throughout the day. And join our Market Outlook community that we created on Facebook. Also, come over here while you're watching the video. Come down below the video and click on this heart right here. And then hit that like button. Again, that's another way to tell us you want us to do the video again tomorrow. You can also do it on Facebook by clicking on this image, and then here on our blog by clicking on that like button. So we look at how many people are watching and how many people click on these, and that gives us a good idea of what you're thinking and about these videos and how much demand there is for us to keep on doing them. All right, when you look at the long-term chart here, you can see today, this week so far. Now, granted, we have 2 days left in the week, so this is really important where we close this week, right? Because again, middle of the candle doesn't matter as much as the end of the candle. I get a lot of people that will tell me, how things are early in the mornings, only to have the market reverse by the end of the day. It's the end of the period that matters the most. And you'll notice that that 200-day moving average is at 2730. So if we were to bounce in the next couple of days before the end of the week, that's your target as we get back up. We go back to 2015. I mentioned over here that breakdown below support right there that led to the death cross. See, we had been moderating for a year and a half on the MACD from its high point. We had been moderating. You can see we had started to moderate here, but then we really took off this year and formed really high MACD levels in January and again here this year. Even though that was a much lower high, it was still a higher level than what we had all over here. Now, granted, this is an absolute result, right? So the number's going to be bigger simply because of how the numbers over here on the right are bigger. So you can see a little different now compared to what we saw over here in 2015, where we were grinding for so long in a really tight range and we busted out. We're not grinding in a really tight range right now. This is a really volatile range. And when you get the really volatile ranges, they don't break down to death crosses on the downside. Death crosses occur after you've been grinding for a while, and these lines were able to catch up. You can see the blue line didn't catch up to the orange. The orange line fell to it. When the orange line falls to the 200-day moving average, we tend to bounce. See how it falls down, we tend to bounce. When it falls down, we tend to bounce. When it grinds and we catch up to it, that's when you get the death cross. So that's another reason why I'm not totally convinced yet we're going to get the sustained death cross. And as I mentioned before, when you do get it on the Russell 2000 in the past, when you're in these long-term, kind of bull markets here. Let's go to the weekly chart. When you get that death cross, you had this divergence here. That wasn't on the MACD, but it was on a lot of other indicators. In end of 2015 to early 2016, remember the S&P was also in a death cross there. But in some of these others, when you get the death cross, you see at the very beginning, then there's recession right there, and there's recession right there. When you're not in recession, that's where the low points are, and there's a lot of data out here with this death cross that we're getting on the Russell right now. There's a lot of data out that looks at all the death crosses. Here's another one that you can barely see right there that goes out in the past and suggests that in the next year following the death cross, and even here you can see this was August. By August of 2016, we were up. Even though it went lower, we ended up. So a lot of the data suggests that the 12-month returns after death cross in the Russell end up being pretty strong. When you look at the 3 green arrows, we obviously have 3 red arrows right now, or excuse me, 2 red arrows. We haven't got the MACD yet, so this is why. If you take a look at the MACD on the 2 lines here, you can see it's almost back to its moving average. And if you recall, we talked about when you converge sharply up on the MACD, we don't typically go to extreme highs. We go just above it before we pull back a little bit. And that's what we're doing right now, is we're pulling back. And again, there's this time frame that I talked about before that I compared our current market situation to. See, we converged up to the top and we came down back below it and then started up this bullish move. That was the first intermediate run, and here's the second intermediate run. So again, similar pattern here that we're getting here as well on the MACD, and you can see also the stochastic. But stochastics didn't get down to the reversal zone this time. It started back up again. Alright, today's intraday chart shows a lower high at the very open today and the lower low towards the end. We did bounce off of it a little bit at the end of the day, but a lower high and a lower low. We were flirting with last week's high and last week's low and yesterday's low at the end of the day, as well as the midpoint of the chart. So we're trading right around the midpoint, and again, up here is bullish and down here is bearish, and as you get more of a retracement and we break through that 62% retracement, then there's your zone where we fill in that long lower shadow essentially. That's on the S&P 500. So that's what we're going to keep an eye on, right? Because that's your low point that we hold, 260, for a variety of reasons. Doesn't mean that you can't get some weakness in this area. But also doesn't mean that there's going to be some support in this area. So you got a lot of support in this area, and we'll see how much, whether or not and how much it can hold. When you look at today's volume and trading range, as bearish as this move has been, right? Let's take a look at SPY. You notice we barely got to average. The average is at 120. Today's volume is at 125. Today's range was over 4.5 points, but not extreme. Right, so you look at you put this in the context, and you can see this range of over 6 points is obviously over the top of the chart here, over the 52-week average, and this line's still higher. It hasn't jumped up above 2%. That's our level that we worry about, right, in terms of whether or not this pullback is more than just one of these kind of pullbacks, again, like this right here. You can see the volume at 125 million was right there, so a little bit above the average. But you notice that we haven't got that big sharp spike in volume. We haven't got the big sharp spike in trading range like we had these times. These times right here. And there's also another thing too that kind of stood out is volatility. You can see it's kind of trading a little bit above 20 in this area where this old high was. But you notice it's not getting up to an extreme. And I mentioned this in our classes, how the VIX moderates after a surge, right? When you get the surge up above 115% of VIX to VXV, that's a surge. After you get a surge, your next bounce, holding the 95-90% levels for support, the next bounce is usually to extreme levels above 105. That's your typical extreme level. Then you pop back down again, and then your next peaks tend to be right around the 1 level, and that's where we're at right now. Again, we saw this before earlier this year. We had the surge above 115%. Then the next jump in volatility got you up to extreme highs. Then we bounced back down. Then we flirted around with 1 for a while before coming down. Eventually at the beginning of May, and breaking below 90% and moderating with a couple brief spikes up to 1, but then right back down into the bullish zone. So, again, we're in this stage of mid to late April in terms of volatility gains right now, according to the chart. And as I said, we've seen this play before act out, and we're in the surge is the first act, and the move to extremes is the second act. Then the move to 1 is the third act, and we're in the third act of that play. So to summarize, again, when you have volatility in the high teens and close to 20, you're going to get big moves to the upside like we saw previously, and we're getting a bigger drop down to the downside, which seems bearish. It's kind of hard to, a lot of people talk about how, we're in this bear market, and And we haven't even dropped past the 62% Fibonacci retracement line, right? It's again hard to be too bearish until it's more of a Fibonacci retracement, until we break down to new intermediate low points, which we haven't. We just haven't yet done that. 2600, now things change, but until then, we've seen this kind of volatile pullback play out into a new market sentiment run earlier this year. It hasn't been that long. We've already seen it play out earlier this year, and we didn't have the seasonality of the year to help us out. So that's what we're seeing. So what do you think? Do you agree with that or disagree with that? Click on in the poll that's popping out there, and then hit agree or disagree. If you click disagree, scroll down to the bottom. Love to hear your comments and love to see what you're seeing. Share, charts or patterns that you're seeing that would suggest that maybe we are that bearish, even though we haven't broken 2600 yet. That we're that likely to do so because of whatever pattern it is that you recognize on the chart that would suggest that. We'd love to share that with the community down below in the comment section. All right, now let's take a look at what's the Drivein price action today. You can see crude oil started. Remember how yesterday crude oil had such a big move to the downside with an extreme amount of volume, especially on the ETF. Very capitulation type move. Here's the bounce. Here's what happens after capitulation type moves. A big time bounce here. You can see small cap stocks and emerging markets right here. These two were the two biggest gainers on the day. By the end of the day, small cap stocks ended up down with the S&P 500, but emerging markets stayed higher. In fact, weakness in the dollar, which is this kind of blue line right there, there's your dollar. It was weak today, which again is not something you typically see when you have a big risk off move. It was down, gold was up, and again, emerging markets being up too. Not typically something you see as a risk off move. So keep that in mind in terms of how risk off we actually are right now. Long-term bonds, you can see here, well, there's your EFA. Long-term bonds would be, let's see, this kind of yellow line right there. They started the day weakest of all and then rallied by the end of the day and actually finished up, you notice, really close to short-term bonds. See, when you are in big risk-off moves, short-term bonds, gold, and the dollar end up being the best performing asset classes. When those three are up at the top, that's when you worry. Crude oil usually is not at the top at the end of big risk-off moves. Same thing with emerging markets; they tend to underperform. So, there's some things in here. High-yielding asset or corporate bonds outpacing investment grade is not a risk-off relationship. And of course, S&P 500 outpacing small caps is a positive sign, or is a risk-off move. Value outpacing growth, but you notice they were all down here, and even MLPs were down with the strength in USO. So it was basically a sell-off of U.S. stocks that didn't necessarily play out all across the board. In fact, if you look at the foreign markets here, SPX is down here at the bottom, down with small cap stock, U.S. small cap stocks, and then there's Australian stocks, Russia, Brazil, Poland, Turkey, EEM. These were all at the top today. So emerging markets really holding up well. And again, you look at the charts for all of these. You look at the 12 grid chart here. You can see they still continue to all look very similar. The S&P 500 had relative strength for the longest time, but now they all kind of look very similar. And so the S&P basically caught up to the weakness that you saw all across the board. Again, something very similar you saw at the end of 2015. But now we don't have sharp weakness all across the board. We're moving away from 3-month lows. It's moving, these 3-month lows are getting pushed. In fact, some of these 3-month lows are way over here, like you see with Russia. And then you can see China is above its moving average. India is back above its moving average. Brazil is way above its 3-month lows. So they're starting to gradually move over to the left. Same with the S&P 500. So as I mentioned previously too, that I expect the next round of next long-term move in U.S. stocks to be driven by foreign stocks. Again, similar to what we saw at the beginning of 2016 that led to a 2-year run there. And I don't think we'll get a 2-year run now, but it led to a 2-year run then with a weaker dollar, where international stocks, where U.S. stocks did really well from 2016 through most of 2000 to the early part of 2018. That foreign markets did better, right? The U.S. market stocks had really good returns, but they were lagging behind. They were kind of being pulled up by what we saw on these areas, coming off a sharp low. So these are all, remember, there's weekly clusters in all of these. So there's there's weakness in all of these, and the bounces in these would lead to a move higher, I believe, in U.S. stocks. Now let's transition to sectors, and you can see today's sectors, interestingly enough, technology was down, but the consumer discretionary kind of matching the market's declines today. But look at communication services, that new sector with Facebook and Netflix and those social media type accounts doing much better than the old tech industry, which is now essentially Apple, right? XLK, with Amazon being an XLY, so everything else in XLC. So again, you look at the sector chart, which has been altered to show the rankings on the sector selector tool. Remember, if you market scholars can break that tool down into industries and individual stocks, but here's the sector rankings: utility, staples, all above their moving averages, real estate as well. There's communication services, XLY, XLV. It's 3-month lows. I mean, it all looks very similar, right? 3-month lows right about in this area that as of right now are starting to slowly gravitate. Now, XLK came down to its 3-month lows, and XLE formed another oversold cluster today. So we'll see if, this bounce off of these lows and these really oversold areas leads everything else higher. I mean, you got strength in the safe haven areas, of course. That's not a surprise. There's your safe haven areas, and this is relatively safe haven. But you can see there's where your, this is the energy sector is below 20. It's the first one. Technology is the next one. That's below 30. So we'll see if a break below those lows on both of these most likely will lead to a break below lows. And I don't mean a breakdown on the intraday basis. I mean a close below those lows would signal a breakdown in the rest of the broader market, most likely. All right, one area in the market that really sold off the most during this pullback is this material sector. You can see it really dropped off pretty sharply during the beginning of October. Remember, it already had some weakness before October the 3rd, whereas the market had peaked here. So you already had some relative weakness. It really exacerbated during the pullback, the decline. So materials was one of those three sectors, in industrials and energy, the others, that were down the most. Then they bounced up all pretty well. Materials especially bounced up really well. And you notice during this pullback, which you remember has hit 62% retracement on the S&P, has only hit 38% retracement in the materials sector. And this is a sector we would expect, based on the cycle, the economic cycle and business cycle, that we'd expect to do well. If we were to get another bullish run here, especially if international stocks outperform, because it's very similar. Same things apply to both areas. Weakness in the dollar would help international stocks and would help these particular sectors. So one stock that had a good bounce today despite the weakness in the market is Newmont. Newmont had a really rough earnings report, but it didn't get it to new lows, and we've since bounced off of it and are trying to break up and potentially break out back up into this range, in the 38 range. You can see the stochastics getting into higher levels. If you look at the Bollinger Bands for Newmont, up in the upper half, you can see you have strong volume in this area. So, and a breakout through here would get you up to this 37. So this would be a good strong move if we were to break out in that zone. And you see you've got if you look at the 3 green arrow chart here, for Newmont, you're back above a rising 8-day moving average, which itself is above the 17-day, and you're close to crossing above the moving average, which would give you the green arrow there, and the stochastics would give you a phantom green arrow in the high part of the chart. Decent volume and a little bit of an inverse head and shoulders pattern developing here. You take a look at the market forecast for Newmont Mining, and you see its near trend line coming up off of a bullish low. It'd be a higher low, coming down from what was a relatively bullish high. It wasn't to a higher near term high, but it got up above 80, pulled down to a bullish low and bounced up. Kept the bullish posture there, and you can see market sentiment now is rising. It's still weak, but it's rising, which again would suggest there's significant opportunity to the upside here if you were to break out above these highs. Finally, let's take a look at the long-term crossover chart here for Newmont. Give me a second here. There we go, and you can see again kind of consolidating in this area below the 200-day moving average, but now we're getting up above the 50, and the 50-day is starting to rise. So there's some opportunity to make its way up to at least a 200 and up into this 35 area here. And then finally, one last chart to look at, the DMI that we typically look at here, kind of a series of charts on this video. We're getting a crossover below the 25 level. So there's opportunity. That tells you there's a trend, not as strong as being below 20, but it's pretty decent to get a breakout move. See here, you had a downward breakout. It didn't break down. We held that support and bounce, but those are the crossovers you look for at these relatively low levels that would send the line up above 25. That didn't say above 25 as long as say that one did, but if the blue line gets up there, then you'd expect a bullish trend to come out of that, especially with all the other charts that point towards a bullish breakout. So what can we do? Well, you can look. You can be a little bit more conservative and keep a high probability and sell the 32 put, buy the 30 put for protection against a downside move. You can also come over here to January and buy this at the money. Well, it'd be the 32. Buy the at the money call option. It's really cheap because the price is really cheap. So you can go. In fact, you can position size a full maximum loss of $174 per contract, and then let that thing run, right, and see how far up it goes. Because again, if you do the Theo price here and reset that, and you have till January, so you have 65 days. Let's say by January the 18th, you can see you'll have 40 cents of intrinsic value left in that option. And let's say the stock does go up $5 up to that 38 level, 37.5 level. You can see what the returns would be. You get 540 is what it'd be worth. So you get about $370 there on $170 of risk. So decent reward risk ratio, and that's at expiration, much less any time before expiration while it still has time decay. If it makes a big breakout to the upside, similar to what you saw here to the downside, be something similar to this. Right? See, this was a 1 month move that took you from 36, 35 all the way up to 42. So two different ways to trade it with the long call option, which is probably where I'd lean a little bit more towards right now because of how cheap the long call is. You can really manage the risk. You wouldn't do a normal position size because of the speculative nature of the trade, but you gives you a better reward to risk ratio considering the environment that we're in. The volatile environment, which usually leads to bigger moves initially to the upside before those moves slow down in a sector that you would expect, that we are expecting based on the cycles, to lead any bullish moves eventually out off of these lows. We already see the strength in materials during this pullback. It hasn't pulled back nearly as much as some of these other areas have over the past week. All right, now it's your turn. I'd love to hear what you have to say. What do you think, or what are you seeing, or what questions you have, what comments do you have, anything that stood out to you today? There's that link that popped out in the top right corner of your screen that will take you to our forums. Market Scholars, remember you have to subscribe there. You can do it for free, but post in our forums on any comments that you have about tonight's market outlook, about what's driving the markets today, or any questions, as well as tonight's trade idea. Remember, thank you very much for watching our video each and every night. Thank you for those that check this out for the first time. Hope you come back tomorrow. Subscribe to our YouTube channel. Click that thumbs up icon. Comment. Follow us on Twitter for more content like this, and then join our community on MarketScholars.com as well as our Market Outlook community we created on Facebook. Have a great rest of your evening, everybody, and we'll see you all next time.